One island, 130 kilometers from China, manufactures more than 90% of the most advanced chips on Earth. No backup, no second source. If it stopped tomorrow, Google servers, Apple's factories, and every major AI lab on the planet would be in serious trouble within days. Its name is TSMC, and it just posted the best year in its history. Meanwhile, the company that could have owned this entire industry, America's own Intel, is now more than 10% owned by the US government just to survive. We'll get into exactly how a company that once turned down Apple ended up needing a government bailout to get Apple back. This isn't really a story about chips, or even really about who wins a manufacturing race. It's a story about what happens when the company that invented an entire industry spends 20 years making a series of individually defensible decisions that add up almost invisibly to nearly losing that industry completely, and what it costs, literally, to try to buy your way back into the game. Intel didn't lose this by accident, and it didn't happen in one bad quarter. In the mid-2000s, Apple came to Intel with an offer to build the processor for a device that didn't exist yet, something that would become the iPhone. Intel CEO at the time, Paolo Tellini, turned it down. In a well-documented 2013 interview with The Atlantic, he later admitted the decision came down to price. Nobody, including Apple, knew what the iPhone would actually become, and Intel's own cost projections for the chip didn't clear the bar the company demanded from every product line. Apple took the business instead to a much smaller, much hungrier company most Americans had never heard of, Taiwan Semiconductor Manufacturing Company, known as TSMC. That single decision didn't just cost Intel one contract. Apple's volume gave TSMC the guaranteed demand it needed to justify investing tens of billions of dollars into next-generation manufacturing, node after node, years ahead of where its balance sheet alone would have allowed. It helped fund the rise of the company that now builds nearly every advanced chip that Apple, Nvidia, and AMD design. By 2011, Apple's own Tim Cook was telling TSMC's own founder, a conversation Morris Chang later confirmed publicly, that Intel just does not know how to be a foundry. That's not an outsider's opinion or a rival's talking point. That's Apple's own verdict delivered directly to the company that ended up eating Intel's lunch for the next 15 years. Here's where it gets serious and where the consequences of that history fully caught up with Intel. By late 2024, the company posted a $16.6 billion loss in a single quarter, the worst quarterly result in Intel's entire history. Its stock had fallen by more than half over the course of that year alone. In November 2024, Intel was removed from the Dow Jones Industrial Average entirely, replaced by Nvidia, a company Intel could have owned meaningful business from a decade earlier had its manufacturing strategy gone differently. That December, CEO Pat Gelsinger was forced out by his own board after years of trying and failing to execute a turnaround. His replacement, Lip-Bu Tan, took over in March 2025 with a blunt public diagnosis: there are no quick fixes. Tan moved fast and cut deep. Intel's headcount fell from roughly 125,000 to about 85,000 by the end of that year, a workforce reduction of nearly a third, carrying a $1.9 billion restructuring charge along the way. And then came the part that made this genuinely unusual, even for a company already in crisis. In August 2025, the US government converted its CHIPS Act support into an actual equity stake in Intel, roughly 10% of the company, worth somewhere between $9 and $11 billion. The United States government is now functionally a part owner of a publicly traded semiconductor company. That is not a normal event in American capitalism, and it hadn't happened at this scale to a company of Intel's size. It happened because the alternative, the country's only remaining leading-edge domestic chipmaker collapsing entirely with no backup plan, was judged to be worse than the political awkwardness of the government owning shares in a chip company. A month later, Nvidia added another $5 billion of its own, closing the investment in December 2025 for roughly a 4% stake, a striking move given that Nvidia and Intel had spent years as direct competitors. By the first quarter of 2026, there were real, measurable signs of life. Revenue up 7% year over year, the data center business up 22%, and even the long-struggling foundry division growing 16% to $5.4 billion in quarterly revenue. By the second quarter, Intel's foundry losses had narrowed to $2.1 billion, still enormous by any normal business standard, but a real improvement from the $3.2 billion loss the same division posted a year earlier. Now, compare that recovery to TSMC over the exact same stretch of time. $40.2 billion in quarterly revenue in Q2 2026 alone, up 36% year-over-year, funded almost entirely from its own operating cash flow rather than government rescue packages or a rival's strategic investments. TSMC isn't just winning this competition, it's operating in a completely different financial universe than the company it outmaneuvered, one where a single quarter's revenue nearly matches what Intel's entire foundry division might generate in an average year. If you want more stories like this, where a company's 20-year-old decisions come back due with interest, that's exactly what this channel does every week. Subscribing helps me keep making these. No pressure, but I'd appreciate it. So how does a company with Intel's head start, decades of engineering dominance, the Intel Inside brand recognition, a monopoly-like grip on PC processors, end up here? Not through one bad decision, through a pattern of them, each one individually reasonable at the time it was made. Turning down Apple in the 2000s made sense on a spreadsheet. The margins TSMC was willing to accept looked unattractive to a company used to owning the entire high-margin PC processor market outright. Sticking with its own in-house manufacturing model rather than embracing the fabless approach that let companies like Nvidia and AMD focus purely on chip design while outsourcing the expensive, risky business of actually building the chips, made sense to a company that had built its entire identity for 50 years on doing both design and manufacturing itself. Even the years of internal hesitation over committing fully to next-generation lithography investment made sense to executives worried about betting billions on a manufacturing technology that might not pay off before the balance sheet buckled. Meanwhile, TSMC made one strategic bet over and over for 3 decades straight: manufacturing only for every customer willing to pay at maximum scale, reinvesting profits faster than anyone else in the industry into the next generation of process technology. When Apple needed a manufacturing partner willing to bet everything on scaling up fast for an unproven product, TSMC said yes to terms Intel considered unattractive. That single willingness to take a worse deal in year one in exchange for building the relationship that would define the next 20 years is arguably the single most consequential business decision in the entire history of the semiconductor industry, and it wasn't made by the company everyone was watching.
This is a pattern worth recognizing anywhere. A dominant incumbent faces a smaller, hungrier competitor, and it goes well beyond chips. The incumbent's rational, defensible quarter-by-quarter decisions are exactly what create the opening for the competitor to walk through. Intel wasn't reckless or poorly managed in any obvious way during the years that mattered most. It was disciplined about protecting margins, cautious about big bets on unproven customers, and protective of a business model that had made it enormously profitable for decades, all things that read in any given year as good management. TSMC, by contrast, could afford to take risks in exactly the ways Intel couldn't, precisely because it had a fraction of Intel's revenue to protect and everything left to prove. Being the incumbent with something to lose is, paradoxically, often the exact condition that makes you lose it, because every individually rational decision to protect what you have is also cumulatively a decision not to take the risk that would have kept you ahead. There's a strange twist forming right now that makes this story worth watching closely instead of treating it as already resolved. Reports emerged in May 2026 that Apple, the same company whose 2011 rejection helped cement TSMC's dominance, has reached a preliminary agreement for Intel to manufacture some of its chips going forward. According to reporting on the deal, President Trump personally advocated for the move, pushing for more US-based manufacturing of Apple's components, with Apple committing $400 million toward that goal. Apple joins Nvidia in reportedly Elon Musk's planned $119 billion Texas chip facility on the list of companies now giving Intel's foundry business a second look, not purely because Intel has proven itself technically superior, but because a mix of geopolitical pressure, direct government ownership, and political persuasion is now actively steering business back toward American manufacturing capacity, whether or not the underlying economics would have gotten there on their own. Intel's own leadership has been careful not to overpromise on the back of this momentum. CEO Lip-Bu Tan has publicly called 2026 an execution year rather than a growth year, with any real inflection point not expected until 2027 at the earliest. Intel's most advanced manufacturing node, called 14A, remains a 2028 commitment, with no confirmed high-volume external customer locked in yet. Meanwhile, TSMC's own capacity is arguably becoming the real constraint on the entire AI industry now. The company is reportedly sitting on roughly $1 billion of finished iPhone chips it can't fully complete due to memory supply bottlenecks elsewhere in the supply chain, a rare, telling sign that even the dominant player in this story is running up against real limits of its own. Maybe the real story here isn't Intel's fall or TSMC's rise as separate narratives, it's that the world's entire AI build-out currently depends on a single company, on a single island, 130 kilometers from a country that has never ruled out taking it by force, and that a single geopolitical event could disrupt overnight with no real backup plan on standby. The US government didn't buy a stake in Intel because Intel had earned it back through performance. It bought it because the alternative, having no serious domestic alternative for the most important manufacturing capability in the modern economy, was judged too dangerous not to fix, whatever the price, and whatever the awkwardness of the government suddenly owning shares in a chip company most Americans had already started counting out. If you want to understand how these companies actually operate, not the headlines, but the real mechanics, that's exactly what this channel does every week. Subscribe if you want to keep seeing it.